you remember Meet the Parents where Gaylord Falker got the ninth place ribbon, I think there are a few ribbons being given out for not spectacular performances.
IG North America CEO JJ Kinahan there comparing some of the results season's beats to Ben Stiller's character in Meet the Parents. The inference being that low expectations have set a comfortable earnings bar for some companies to jump over. Well, as the Q1 earnings season draws to a close, it appears that S&P 500 revenues are expected to decline slightly year over year. Now, that outcome would be much better than the pessimistic forecast made earlier. Though Q1 results were more resilient than the bears expected as companies managed costs or managed to pass them on to the consumer. Joining us now for the takeaways from this earnings season is Christian Ledoux, CAPTRUST Director of Investments. Good to see you, Christian. So is it fair to say that the bar was so low that we really shouldn't be that impressed with this earnings season?
Well, yeah, the bar has been set low. This has been a very widely telegraphed slowdown, if not recession, and in some people's minds, it's going to be a very deep recession. But I think the fact that it's been telegraphed so well is allowing companies to manage their costs and keep their earnings relatively stable. And that's actually good for the markets.
And what about some of the forward guidance? Because obviously we're still seeing that it's a bit cloudy as to what the Fed is going to do. Although the Fed has said, in no uncertain terms, it doesn't foresee cutting interest rates this year. But then you have this divergence between what the Fed is saying, what stocks are doing, and what bonds are doing.
Well, if you go back into history, it's always been the market that's been right. The Fed may talk a good game, but when it comes down to predicting where the economy is going and what that's going to require the Fed to do in the future, the market has a very good track record of predicting it correctly. So I would say that given that we are seeing slowdowns throughout many of the leading economic indicators, companies are cautiously giving their guidance. They're not expecting a lot in terms of revenue growth. It's indicative that we are going into a slowdown, possibly a recession, and that the Fed will probably have to respond with lower rates.
And obviously that being exacerbated by what we saw with some of the banking fallout, still seeing that reverberating a little bit, that sort of psychological crisis of confidence in what happens with the banking system. How much is that going to sort of either speed up or deepen the recession?
We think this is one of the biggest factors that is being underestimated out there. Banks are going to have to hunker down, for lack of a better word, when you have potential deposit flight. And you may have to patch that hole in the boat with the bank lending window from the Fed. That costs money. I mean, that's 5% interest rate to the cost of the banks. And they're not going to want to lend any more than they have to keep those deposits invested. So you're going to see a pretty broad-based decline in lending activity in the banking sector. We can only hope that the private credit markets can fill in some of that, or maybe even bond issuance.
And then, of course, we had a very hotter than expected unemployment report that came out as well. I mean, for some of it, it seemed at first the markets were sort of shrugging that off. I mean, they do really seem to be ignoring the Fed at the moment. And as you mentioned, that if the market's always going to be right, what does that mean then for the outlook, for the performance, especially when we look at the performance from mega caps?
Well, mega caps are the new consumer staples. I mean, prior cycles, you would go to food companies, maybe utilities, as your way of hiding out and waiting for the storm to pass. Mega cap tech companies have filled that role this time, and it may continue to fill the role because they're so big, they're so liquid, they have so much opportunity to manage their costs, and their revenues are fairly stable and growing. So it's a very attractive quality for investment. But that being said, these companies have been extended quite a bit on valuation, and we may not be able to see them go much higher without either dragging the market up with it, or you actually see a decline in the stock market as a whole.
And so for people who are looking for some opportunities, you have some picks here. I want to start with CVS Health there. What do you see there in terms of upside for CVS here?
Well, we could see the stock recover most of its losses over the last 12 months. This stock has come down quite heavily, actually, and more than we would have expected, on the backs of an acquisition that was dilutive into the primary care business, and in terms of the potential regulatory on their pharmacy benefit management segment. But they're building a nice vertically integrated healthcare company. They pay a nice attractive yield, 3.5%, and the business is relatively recession resistant. So I think there's a lot of attractive qualities. I think it's gone a little bit too far to the downside, and you could see a nice pop from here.
And then interestingly, in the energy space, you like EOG Resources and then Airbnb as well. Walk us through just quickly those two scenarios.
Sure. Well, energy we think of as primarily portfolio insurance. You know, there geopolitical events can happen that can make commodity prices spike. You can see OPEC cut their production in order to boost prices, which they did earlier this year. These are companies that will benefit of that, of course. But this isn't a rising tide lift all boats type of environment. You want to go with the best operators, and EOG is certainly in the top tier in that regard. In terms of Airbnb, this is a share gain story. We continue to see travel is doing well. We don't expect that's going to continue indefinitely. But when travel does slow down, I think we're going to see consumers lean a little bit more towards the type of rooms that Airbnb offers rather than traditional hotels. They tend to be a little bit cheaper and a little bit more interesting areas to travel into. So we think Airbnb is a share gain story, and they have a mostly fixed cost infrastructure. So any kind of growth goes right to the bottom line.
Yeah, that travel trend story is going to be an interesting one to see how that plays out. A big thank you, Christian Ledoux, CAPTRUST Director of Investments. Thank you for joining me this morning.